Start by opening an IRA. Expand your investments using index funds and ETF, and invest no more than 10% of your portfolio in company stocks. For many Americans, an employer-sponsored 401k is their first investment vehicle, with 65% of U.S. workers offered one or a similar plan. But to build wealth, you also may want or need to invest outside of that plan. Here are 5 investment strategies beginners can use to get more involved in the stock market. Welcome back to Entrepreneurship 101. Today we'll talk about 5 strategies for investing in the stock market. Before we start the video, please like, subscribe, and press the bell icon. Number 1. Open an IRA. After an employer-sponsored retirement plan, the next stop for any stock market strategy is to invest in other tax-advantaged accounts, such as a traditional or Roth individual retirement account. You can open an IRA at an online broker. Many brokerages don't require an account minimum, and you won't be investing any of your money until you're ready to do so. These days, brokerages are pretty similar to banks. The significant difference is that with brokers, you'll have access to the stock market when you're ready to invest. You can contribute up to $6,000 a year, $7,000 if you are 50 or older, to an IRA, either to one account or a combination of these types of IRA. Each has different tax advantages, so check out which IRA is best for you. And if you max an IRA out for the year, you can always continue investing in a taxable brokerage account. These are also opened at an online broker, but they don't offer the tax perks of an IRA. Number 2. Only invest cash you won't need for 5 years. One big drawback of traditional and Roth IRA: there can be penalties and tax ramifications if you withdraw funds before the age of 59.5. Roth IRA are more forgiving on early withdrawals. You can pull out contributions anytime, but you may be penalized or taxed if you pull out investment earnings early. But that restriction might be okay, because there's a fundamental rule to keep in mind with any stock market strategy. Don't invest cash you'll need within 5 years. Patience pays when investing. It would be best to give your assets time to weather the market's ups and downs. A key rule of thumb to keep in mind with any stock market strategy: don't invest cash you'll need within 5 years. If 59.5 feels too far away, a taxable brokerage account won't penalize early withdrawals. Still, it won't offer the tax advantages of an IRA or employer-sponsored account. Most brokers provide taxable and tax-advantaged accounts. Opening a taxable brokerage account may be the next step if you're already maxing out a 401k and an IRA and have idle cash sitting in your bank account. However, the following strategies can be applied to retirement and brokerage accounts. Number 3. Explore passively managed index funds. Ideally, you want to create a balanced portfolio while keeping costs down. Most investors lean on mutual funds, index funds, and exchange-traded funds. Rather than betting on any company stock, these funds pool multiple inventories together, balancing out the inevitable losers and winners. And these funds are built on passive management strategies. Passive investing seeks only to match broader market gains as opposed to active investing, which tries to outperform the market by frequently buying and selling stocks. And while having an expert pick and choose supplies for you may sound appealing, in the 5 years leading up to December 31, 2019, 80% of large-cap funds underperformed the S&P 500. In other words, if you'd invested in a low-cost index fund that closely tracks the S&P 500, there's a good chance you would have seen better returns than in the average mutual fund. Passive investing also brings fewer fees that can erode long-term investment growth. In 2019, the average passively managed fund had an asset-weighted expense ratio of 0.30%, compared with 0.66% with actively managed funds. This cost difference has sparked a growing array of robo-advisors that automate portfolio management, which allows these companies to charge much lower fees than actively managed accounts. Number 4. Limit active stock trades to 10% of a portfolio. Keep these to 10% or less of your total investment portfolio if you want to buy stocks. Again, actively managed stock market strategies that seek to beat the market regularly underperform passive strategies. Suppose you throw all of your money into one or a few companies. In that case, you're banking on the success that could quickly be halted by a single regulatory problem, new competitor, or public relations disaster. Suppose you still have a strong interest in actively trading with a portion of your portfolio. In that case, some stockbrokers offer educational tools and simulators that allow you to practice trading before you dive in. Number 5. Use dollar cost averaging. Active investors race to buy low and sell high, but that's easier said than done. A better strategy is to make new investments at regular intervals, a process known as dollar cost averaging. Successful investing is less about timing the market than giving a broad portfolio of assets the time to grow. Unlike the friends at Image, you may have of stock market trading, slow and steady. That's all for today. Thanks for watching the video. If you enjoyed it, please comment, like, share, and subscribe to our channel for more exciting content.